So we're looking at the world of global equities today. What's a good value buying opportunity and why are they so scarce right now?
Yeah, good question, Mia. We've had a situation, we think, where equity markets have generally been bid up to levels that find attractive investment opportunities, quite scarce. One that's a favourite of ours at the moment in terms of our portfolio is CVS Health. It's a US-focused business that has three main business lines. Traditionally, and its core business is the largest pharmacy retail network in the United States. It also has the second largest medical benefits management business, and it's got a second tier health insurance company. And the three of those, we think, create quite a potent healthcare offering. So the integration of that healthcare insurance business, AITA, into the group will enable it to sort out two of the problems that they've really had over the last couple of years. It allows them to roll out health hubs, and with an increasing proportion of Medicare provided through those health hubs, we think that provides two distinct benefits for the combined group. One, it brings foot traffic to their core retail pharmacy, and that will, in many cases, offset the threat that's been overhanging the stock in terms of the online players and sort of their offering competing against the traditional retail format. And it also enables the health insurance business that's provided medical costs at a lower cost to patients. So when they check into the medical and hospital centre, so integrating all three. Clearly, CVS Health's benefited in the last, particularly 6 months in the US, because it's played a critical role in the rollout of the vaccine program in the United States. New leadership under CEO Karen Lynch and CFO Eva Barota, we think is very strong, and we think the integration of those three, particularly the AITA health insurance business, into the core business is going to be key over the next couple of years, and we've got a lot of faith in those two under their stewardship. And so that's the story, that's the thesis, but ultimately it comes down to value. And this is one of the great healthcare businesses, we think, in the US. It's trading on 10 times earnings today, which is definitely a rarity in global equity markets. And expectations are that its earnings will grow by more than 30% over the next 3 years. So in terms of opportunities, we see that as one of the clear cases for a great investment opportunity, actually.
That's a great example of, how you look at valuations, PE ratios. Are there any other characteristics of a good value stock?
Yeah, sure. I mean, and part of that's to try and also isolate the way we define our investable universe. So within the global equity franchise portfolio, we will only look at investing in companies that we deem as having an economic franchise. And what that really comes down to is it's a business that we think we have a better handle on predicting its earnings or cash flows over the next 5 to 10 years plus. So what we're talking about there are businesses that have what we call a source of economic franchise. Now, it's a term that's used by a number of people to mean many different things, but for us, the economic franchise generation and ability comes down to that predictability of earnings. Does it have a certain characteristic that produces this predictable earnings stream? Because ultimately my job is to define some earnings or pick some earnings, forecast some cash flows and apply a multiple or a discount rate to it to come up with a valuation. Now, if I can find a bunch of businesses that are more predictable, that makes my job as a valuer easier, makes my job as an investor easier. I'm more likely to get those investment problems right. And we think you're more likely than not, therefore, to make money for clients. So when we talk about our value proposition, it's framed in that economic franchise universe. And so types of companies we're talking about there are natural monopolies. So, core infrastructure businesses like National Grid of the United Kingdom, companies that are clearly have seriously high levels of economies of scale. They're cost leaders. They have scale advantages. Companies like Stericycle in the United States that deals with regulated medical waste. There's the classic networking effect businesses, Visa, MasterCard, businesses that the more people use them, the more powerful that business becomes. They're wonderful businesses, often trading at very lofty valuations, but occasionally you can get ones that we think are good value. Visa is one that we've bought a position in recently. There's the classic consumer products firms, the brands such as Colgate Palmolive, those companies that have a strong patent lists like Medtronic. They use their intellectual property to generate that earning stream. And then there's companies that have high levels of switching costs. They're typically businesses that are, almost in the background very much. Companies like ADP that do our payroll for myself at Lazard. They also do it for 2/3 of people across America. The companies like Oracle that are, mission critical software and hardware providers that have very high switching costs. So yeah, they're the sources of economic franchise, if you like. Natural monopolies, cost leaders, companies that have network effects, brands or intellectual property, or switching costs. And it's all around those sources of economic franchise driving consistent, predictable earnings.
And you have quite a concentrated portfolio. How do you approach, that mentality of honing and screening that universe down to, I think it's about 30 stocks, is that right?
Yeah, it's around 30 odd stocks, 28 today. And it's not a case where we'll just say, oh, we'll only ever own 30. I mean, we have a bit of flex into our portfolio diversification. So we can own up to 50, we can own as little as 25. So we're at the lower end of that today. And that is really born out of the fact that we do find a dearth of genuine investment opportunities out there that are attractively priced. So because there are markets we think are generally expensive, because there are very few companies that we're comfortable owning, that we think will generate a decent return today, we've concentrated the portfolio in those names. So as I pointed out before, companies that have those sources of economic franchise, we believe are more predictable. We only concern ourselves with those companies. So, we're not concerned with the 5,000 companies that are listed in the MSCI world today. We're really only focused on around about 230 odd stocks. And as you pointed out, today, in terms of value opportunities, we only own about 28 of those. So the confidence to make that sort of concentrated value decisions really comes down to our confidence around the earnings predictability of those businesses. And it doesn't mean that, the effects of the pandemic didn't affect them, but it means if you're a market leader, you can adjust your business when those types of externality events occur to actually navigate those waters better than a company that's highly competitive. So, when we think of our universe, the types of stocks that we shy away from because we think they're too competitive or too hard to predict, banks and insurers, we don't invest in any of those. We won't buy energy stocks or miners. So, we're not really a classic value manager in the sense that we're looking to buy those beaten up, companies that are trading on low price to book with, and very low return on equity. We're typically hunting in a space that has companies that are highly financially productive, generate great return on assets, but we do it with a value focus.